Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Now, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so well over a full year now, has been and still is, though it was once again breached and repaired only as recently as early October. It is the dark blue September to December 2024 bear channel, currently 1116 to 1572, that has developed into a descending expanding wedge pattern. The mauve medium moving average, currently at 1583, and I suppose to a certain extent the green short medium moving average, which is currently at 1539, are both paralleling the dark blue upper trend line. There are two other patterns that have been greatly influencing this market. The first, the origins of which I have spoken about at length, is the bright green late September 24 to mid-January 2025 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 34 weeks ago, and it seemed back then to be a better contender in showing the bearish angle of attack. But this did not last, and I finessed it to the shallower bearish shift pitchfork for the same move, which is much better at showing the bearish angle of attack. Today we're in between the overhead bright green middle time, currently at 1543, and the bright green lower time below, currently at 1317. The second is another larger bearish pattern, which I have also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 2024, similar but slightly shallower bearish shift pitchfork. On this one we are just above the bright red middle time, currently at 1467, as well as just above the March 2021 low at 1466. Now 3 weeks ago we had a break below the bright red middle time, pushing down below the previous significant low in late June at 1468, down to a new low, one that has not been seen since December 2020. Indeed, we dipped down to that December 2020 low at 1409 for just about 3 weeks. However, prices have each time backed off higher from this low because, as I said 3 weeks ago, and I quote, "We next have support on the downside on the congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time." End of quote. Well, we have had that stabilization and we are sitting in between the declining bright red middle time, sort of, and the congestion below. However, last Friday, the market shot up with an immediate countering combined key reversal up and bullish engulfing pattern, if only just on the latter, closing well over the bright red middle time. However, this was only the one session, and as always, I look for confirmation, and so far today, this has been, how should I put it, hesitant, with prices seemingly resting on top of the bright red time, not really accelerating, and also the March 2021 low. Looking further down, well, we don't have that much support until the 1248 level, and I'm not too confident in that as well. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot depends on the congestion between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor. I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. First of the three patterns is the obvious broken, repaired, broken again, and lately repaired purple late September 2024 to mid-February 2025 descending expanding wedge pattern, which is currently 436.90 on top to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary back in January this year, and had earlier been severely tested on the top side, enough that I would not necessarily classify as a descending wedge pattern after February, though I continue to still keep an eye on the extension to the purple upper trend line and the failed break above it in September and October, as well as a changeover gap 9 weeks ago, as I believe it all to be significant. Next, I also asked you 29 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it, end of quote. Well, since then, the market initially started utilizing the bright pink middle tine of this bearish shift pitchfork, which is currently at 457.60, as an attractor, riding prices lower in a shallow glide until early October, when it started a further steeper journey lower, such that the market is now closer to the pink lower tine, which is currently at 399.20, which of course will be acting as a potential support. The first time for the lower tine of this pitchfork in its life cycle. The third feature, and it has developed since the beginning of September, and last Friday saw prices very severely challenge it, is the red early September to date bear channel, currently 388.5 to 420.40. This bear channel had been excellent at showing the recent bearishness of the market, and it showed last week's low at 406.40, the lowest low since December 2020. But we then managed last Friday to punch up and out of it, and in the process created a weekly key reversal up. Yet this has only been one session, and today we are back down testing the red upper trend line, resting on it indeed. And it raises questions about the future validity of this red bear channel. It is not done as yet, but it does raise questions. There's one final thing I would caution about. The red upper bear channel line crosses the pink lower tine on the 11th of December, and I would look out for some potential volatility ahead of this as the market gets squeezed between the two. Sugar white premium spread. 9 weeks ago here I said, and I quote, things seem to be trying to resolve themselves into a pattern, end of quote. And over the intervening weeks they seem to be doing so, just not always the way I imagined they would. You see, I thought we might be moving towards, as I cautioned for a number of weeks, and then again I quote, I have a fear, and it's a real fear, that the whole February 25 to date action may be trying to form a possible diamond pattern, end of quote. Now I continued, and I once again quote, this would be a large pattern in time, probably from February through to November this year, and in height roughly between 100 up to 150. It is too early to say if this is happening, but I would urge you to keep an eye on such a possibility, end of quote. That possibility looked like being a real possibility until 9 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line, which is highlighted in dark blue, and that's currently at 125.5. The market not only dropped below this trend line, and let's be honest, it is an unjustified trend line, but went on further to drop and close below the gold long moving average, currently at 105.75, and stabilized further down, dropping and closing below a new support line, the bright red neckline, which is currently at 97.5, of a new, simpler pattern that the market had opted to utilize instead of a more complex diamond pattern, a February to early October head and shoulders top. We were, and I suppose still are, at the early stages of this pattern, but I thought it was appropriate 6 weeks ago to lay out some potentials below for such a pattern, just in case. Thus, the primary target X is down in the 70 even zone, for secondary hard to reach target X1 down at 43.75. You'll easily note that the primary target X is at the lower end of the congestion seen between September 24 to January 25, between approximately 70 even to 85 even. Since then, prices started to stabilize, apparently not following through lower, opening and closing over the bright red neckline, most notably last week when we had a combined weekly key reversal up and bullish engulfing pattern, if that pattern was still below the gold long moving average. However, this week has not seen a follow through higher, not yet at least, and as we opened lower indeed, with the lowest open since early January, back below the bright red neckline. It is, as I said 5 weeks ago, and I quote, only concerted, consistent and long-term moves over the bright red neckline, new bright red neckline, and ideally over the slowly rising long moving average, could possibly assuage the bearish potential at least as far down as the 70 to 85 congestion. End of quote. We have been half there and half not there, and this week's action so far just exemplifies these courses of actions. It is indecision, but on a much larger scale.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.